Welcome to Trading Nation. I'm Mike Santoli. The major averages have all made impressive gains this year, pushed higher by Fed dovishness and optimism around trade. But one market watcher says the positive drivers have been priced in and that the headwinds outweigh the tailwinds at this point. Joined by David Spika, he's president of GuideStone Capital Management. His firm manages more than $12 billion in assets. So, David, what is keeping you a little bit cautious here as the markets have really actually had a nice roll?
Well, Mike, I think you hit it on the head. We feel like the good news is largely, if not all, priced in. The big move off the bottom back on Christmas Eve has been largely around the Fed pause. That's priced in. The Fed's done, the next move's going to be down, and that's probably a bad sign. The other thing that gives us pause is a slowing in growth. Earnings growth has declined significantly. In fact, we're estimating more than a 3% decline in first quarter earnings growth with full year earnings growth of less than 4% versus 20% last year. That's not a recipe in our mind for further gains in the stock market.
Well, I guess what about the argument that, the market tries to look ahead and maybe in the absence of a U.S. recession can stay supported just on, low bond yields, Fed dovishness, and even flat earnings? You're not going to bet that way?
Well, that argument would carry more water if we weren't seeing what we're seeing in the bond market. We just saw an inverted yield curve. We've seen the 10-year Treasury decline precipitously, and the bond market tends to be a really good canary in the coal mine when it comes to future economic growth and future market volatility. And when those two are telling completely different stories, I'm going to tend to lean toward the bond market, especially this late in the economic cycle with this many headwinds. So I don't think that what we're seeing in the stock market is really indicative of what we should expect later on in the year. I think the bond market's probably telling a more realistic story.
All right, well, it sounds like you'd be, counseling a defensive posture here. What does that mean for you in terms of implementing it?
I think investors today should be very cautious with their portfolio. So that doesn't mean you bail out. It doesn't mean you go to cash because no one can time the market. But there are opportunities to look at asset classes that can protect your capital in a downturn. A defensive equity strategy, for instance, is something that would make a lot of sense right now. That'll protect the downside while still giving you upside participation. I also think bonds make a lot of sense here. I think high-quality, investment-grade bond portfolios that aren't too long duration make some sense today, particularly given the fact that, in our opinion, rates aren't going any higher from here. Growth would have to accelerate pretty significantly for rates to go higher. Bonds serve as a good way to generate a decent yield with rates being higher today and also cushioning the volatility of an equity portfolio.
All right, so sounds like you're ready to play some defense throughout the summer and the rest of the year at least. David, thanks a lot for joining us today. Appreciate that.
Thank you.
And thank you for watching Trading Nation. I'm Mike Santoli. See you next time.